Let's get right into it. Welcome to this explainer where we're basically cracking open the secret playbook of the ultra-rich. I've always wondered how billionaires seem to play by a completely different set of rules when it comes to compounding their net worth. So today, we're zooming way past your standard stock and bond portfolios. We're going to decode 15 highly lucrative, frankly obscure investment strategies used by the absolute wealthiest people on the planet. If you're curious about the nuts and bolts of how that hidden wealth machine actually operates, well, you're in exactly the right place.
Okay, so let's start off with a question that literally baffles everyday retail investors. Why on earth would a billionaire sink billions of dollars into a sports franchise that might actually operate at a massive loss? I mean, on paper, it sounds like a terrible business move, right? But here's the thing. The ultra-wealthy aren't looking at these teams the way you or I might look at buying shares of a normal company. They're playing a totally different game, and they're looking at completely hidden mechanics. To break down all 15 of these strategies without making it overwhelming, we're going to follow this roadmap today. First, ultimate tax shields. Second, infinite cash flow machines. Third, the hidden private markets. And finally, becoming the casino.
All right, part one, ultimate tax shields and how they actually keep the wealth they build.
See, the wealthy know a fundamental rule of finance. It's not just about what you make. It is absolutely crucial to aggressively and legally protect what you keep from the tax man. And that brings us to the Veek loophole, officially called the roster depreciation allowance. This is wild. Under US tax law, when you buy a pro sports team, you can actually claim the human athletes on your roster as depreciating assets. Yeah, literally just like factory machinery that wears out over time. Because of this, owners can deduct basically the entire purchase price of the team against their completely unrelated personal income over a 15-year period. To really put that into perspective, think about Steve Ballmer paying $2 billion for the LA Clippers. He wasn't just buying a fancy trophy asset, he secured a massive tax shelter. Over 15 years, he gets to deduct roughly that entire $2 billion against his personal income from, say, his Microsoft stock or other investments. We're talking about reducing his federal tax bill by potentially $50 million a year. The team goes up in value, it generates real income, and it acts as an unbelievable tax shield, all at the exact same time.
But they don't stop there. They stack these brilliant shields. For instance, treating citizenship itself as an asset, like using Puerto Rico's Act 60 to drop capital gains taxes down to literally 0%. Or, instead of just buying insurance, they build captive insurance companies to insure their own businesses, and then they invest that tax-deferred float, exactly like Warren Buffett does. And instead of grabbing standard index funds like most of us do, they use direct indexing. They hold the individual stocks so they can harvest daily market losses to offset their huge wealth events. Every single move is about plugging tax leaks.
Moving right along to part two, infinite cash flow machines, or finding unconventional yield.
So for the ultra-rich, the absolute dream scenario isn't just getting a decent percentage return. The goal is to totally recoup your initial investment, keep the asset, and leave zero of your own money in the deal. It's an infinite return. Watch how they stack real estate to do this. Step 1, you buy a distressed property, raise its value, and do a cash-out refinance. You pull your initial cash out tax-free because loans aren't taxed. Step 2, shelter the future appreciation by buying inside federal opportunity zones. And step 3, you rent that property out to literally the most stable tenant on earth, the government.
That rock-solid stability is the secret sauce here. They're hunting for yield that is completely insulated from the wild swings of the stock market. They love Section 8 housing because the rent is backed directly by the US Treasury. It shows up every single month, whether there's a boom or a recession. They scoop up tax liens to get legally mandated super high-yield interest rates from the state. They lock down perpetual royalties on music catalogs and patents for passive checks. And get this, they even use overfunded whole life insurance as their own private bank. They borrow against it at tiny interest rates to fund new deals, while their original cash just keeps compounding in the background.
All right, let's hit part 3, the hidden private markets. This is all about operating in the shadows. Here is a truth the wealthy know all too well. If an investment is easy for everyone to access, the biggest gains are already gone. Just look at the divide in the art market. When everyday folks buy a painting, they hang it up in their living room and pay taxes when they eventually sell it. But the Freeport art model? That's a whole different universe. The ultra-rich buy multi-million-dollar masterpieces and ship them straight to tax-free zones in Geneva or Singapore called Freeports. The art just sits there, totally hidden, appreciating without a dime of sales or import tax. And then they use that art purely as collateral to get low-interest loans from specialty lenders to fund their next big venture.
And that velvet rope access totally extends to the tech world too.
Think about this timeline. By the time a massive tech giant finally hits the retail public market at, say, year 10, the real life-changing wealth has already been scooped up. Companies like SpaceX or OpenAI are staying private for well over a decade now. The ultra-rich are capturing that 100x growth by buying pre-IPO secondary shares from early employees years, and I mean years, before you or I can even log into a brokerage account to buy a single share.
But they also dominate markets hiding right in plain sight in our own neighborhoods. They execute things called roll-ups. That's where they buy up your local mom-and-pop HVAC or pool cleaning businesses, bundle them together, and sell the giant new entity for a massive premium. They also buy into energy infrastructure, basically collecting toll booth fees on pipelines without ever touching a drop of actual oil. And this one's crazy. Litigation finance. They secretly fund corporate lawsuits for plaintiffs who can't afford the legal fees. If the plaintiff wins, the investor takes a massive cut of the settlement. It is highly profitable, and it has absolutely zero correlation to the stock market.
Which brings us to our final section, Part 4, Becoming the Casino, Apex Ownership.
We have officially reached the true apex of wealth building. This is where sovereign wealth funds and the absolute richest billionaires operate. Think about it like this. If buying regular stocks is playing blackjack with the odds stacked against you, and investing in a private equity fund is being a VIP in the high roller room, well, the ultra-wealthy decided even that wasn't good enough. They don't want to just play the games. They want to own a percentage of the casino itself, collecting a fee on every single hand dealt, in every room, across the entire floor.
So how do they do that? They shift from being an LP, a limited partner, to owning a stake in the GP, the general partner. Normally, a limited partner locks up millions of dollars in cash in a private equity fund for a decade, just waiting for a return. The ultra-rich skip that entirely. They buy GP stakes. This means they are purchasing actual, direct ownership in the private equity firm that is managing everyone else's money.
Getting a GP stake is basically the ultimate trump card. It hands you immediate revenue from the locked-in 2% management fees across all the funds the firm runs, rain or shine. Plus, you get a 20% cut of every winning exit they make. Best of all, you get total immunity to the dreaded J-curve. You know, that agonizing waiting period where early investments usually bleed money before finally turning a profit years down the line? Yeah, you bypass that entirely because your stake earns from the firm's top-line revenue the very second you sign the papers.
Wow. Okay. We've covered a ton of ground in 15 really brilliant wealth strategies today. But I want to leave you with one final, kind of mind-bending Easter egg about alternative cash flows that will completely change how you view value. So ask yourself, what bizarre asset out there could possibly generate $20 million a year in pure cash flow without the asset doing any actual work?
The answer? Syndicated stud fees. Yeah, you heard that right. When top-tier racehorses retire, their ownership gets split into shares and sold off to wealthy investors. A legendary stallion can breed up to 200 times a year, charging as much as $500,000 per cover. These fees act exactly like television syndication royalties for a hit show. It just proves that once you truly understand the hidden playbook of the ultra-rich, absolutely anything can be turned into an infinite return machine. So, leaving you with this. What everyday asset are you going to look at completely differently tomorrow? Thanks so much for checking out this explainer, and keep looking for those hidden mechanics all around you.